You spend decades carefully saving and investing, building a portfolio of $500,000 or more. But the moment you actually need that money, the financial system penalizes you for touching it. Standard financial advice dictates that if you want to buy a house or fund a business, you liquidate. You sell off the assets you worked so hard to accumulate to generate the necessary cash. This data visualization illustrates the dual penalty of that choice. The moment you hit sell, you immediately slice off up to 24% of your profit to pay capital gains taxes. Worse, the remaining money loses its momentum. You permanently halt the compounding interest those funds would have generated. The wealthiest investors bypass this scenario completely. They rarely sell their assets because they know that liquidation is the fastest way to destroy long-term compound growth. To protect your wealth while still accessing cash, you have to approach debt from a completely different angle. There is a specific wealth management strategy known as buy, borrow, die. The first phase is straightforward. Acquire appreciating assets, like index funds, real estate, or company stock, and hold them indefinitely. Let's run the math on a $5 million portfolio to see how two different investors extract $3 million in cash. Path A represents traditional liquidation. Selling $3 million in stock triggers over $500,000 in taxes, severely depleting the portfolio. Path B relies on leverage. Using a securities-backed line of credit, they borrow $3 million, leaving the $5 million portfolio untouched as collateral. Because the IRS classifies this cash as debt rather than income, the $3 million injection is completely tax-free. Look at how the math plays out over time. Path B's intact portfolio continues compounding at a historical average of about 8%. That growth easily outpaces the 5 or 6% interest rate owed on the credit line. Since the yield on the assets exceeds the cost of the loan, the investor is mathematically getting paid to borrow their own money. This creates an obvious problem. Eventually, the investor will pass away, leaving behind a massive accumulating loan balance. The U.S. tax code resolves this with a provision known as the stepped-up basis. After decades of growth, the stepped-up basis resets the inherited asset's cost to their current market value upon the owner's death. Decades of untaxed capital gains disappear. To settle the loan, heirs sell a small fraction of the reset portfolio tax-free, clearing the debt. The capital gains tax liability is permanently erased, allowing the majority of the wealth to pass cleanly to the next generation. While this mathematical framework is highly efficient, leveraging your assets carries specific risks when the market turns volatile. If a severe downturn causes the portfolio's value to drop significantly, the lender can issue a margin call. They will demand an immediate cash deposit, or they will forcefully liquidate the securities to cover the loan. Professionals mitigate this threat by maintaining heavy padding. They typically only borrow 25 to 50% of the portfolio's total value, leaving plenty of room for market fluctuations. Strict mathematical discipline and conservative borrowing limits separates gambling from calculated wealth preservation. You certainly do not need a massive $30 million trust fund to effectively utilize the mechanics of asset-backed debt. Many retail brokerages offer standard SBLOs to investors with a few $100,000 in securities. Homeowners use the exact same principle when they open a home equity line of credit, or HELOC. These tools allow everyday investors to secure short and medium-term capital while letting their underlying assets continue to appreciate. Building long-term wealth requires rethinking your assets. Instead of viewing your portfolio as a savings account waiting to be liquidated, you treat it as collateral to be leveraged.